Hello, I'm James Yardley from Fund Caliber, and today I'm joined by Jay Malhi, Global Market Strategist at JP Morgan Asset Management. Thanks for joining us, Jay.
Thanks, James. Thanks for having me.
Now, you said recently that the mix of growth we're seeing now is better than in the previous market cycle. What did you mean by that exactly?
Yeah, so I think there are some sort of key differences between the start of this cycle and the start of the last cycle. I think in the last cycle, when we think post-financial crisis, banks were very hesitant to lend. And at the same time, consumers weren't really willing to borrow, thinking about the amount of housing debt that they'd taken on. And after house prices fell, they were really looking to deleverage. I think the landscape looks quite different now. The majority of consumers have had their balance sheets protected. If you think about the UK and Europe, furlough schemes having protected their incomes. In the US, we've had unemployment benefits and stimulus checks. So consumers are feeling much more confident now than at the end of the financial crisis. Corporates, on the other hand, have also been feeling more confident, it seems. When we look through this recovery, it seems as though business investment will be picking up much quicker now than in the last cycle. But I think the real game changer here is really about government spending. Post-2008, government debt levels are at very high levels, and they embarked on years of fiscal austerity. Now, though, it seems like the political appetite for austerity is very low, and governments appear willing to keep on spending, essentially, with infrastructure projects and greening of the economy really central to that. And so I think with this fiscal and monetary policy working hand in hand to support economic growth going forward, I think the mix of growth should be much healthier than we saw in the last cycle. And we won't necessarily see that sort of low, slow growth that we saw over the last 10 years.
And the really big question which everyone's asking, with all this extra government spending and so forth, is inflation transitory or is it really going to take off this time?
Yeah, sort of the trillion-dollar question at the moment, and lots to unpack here, I think. But in short, I would say not all inflation will be transitory. So if you think about right now on the supply side, there are lots of disruptions going on, and that's led to higher prices for businesses. They're really struggling to get hold of inventory. So, a lot of high costs at the moment for businesses, and they're starting to pass that on to consumers. And the reason they can do that is because right now, at the same time, demand has rebounded very quickly in the economy as it's reopened. And that's where the businesses are getting that confidence to pass on those rising costs. Now, clearly, not all of those supply disruptions will last for a long time. They will naturally fade as things come into more of a balance and cases, particularly across the emerging markets, start to fall. But I think there are some reasons for those temporary factors lasting a little bit longer. You have some of those rising cases in the emerging markets. That means that those disruptions will probably last a bit longer than perhaps we had first thought. But outside of those supply disruptions, there are sort of two key things that we're watching out for to suggest that inflation is perhaps less transitory than central banks are maybe thinking right now. The first is what happens to wages. And if you look at right now in the US, for example, we are seeing signs that wages are rising. Part of this is due to a shortage of workers right now. It seems that some workers or previous workers are not really willing to get back out into the labor market, perhaps confident that their balance sheet's protected, meaning they're not really rushing back to the first job on offer. And that means that businesses are having to pay up in order to entice workers back into the labor market. So that's sort of one of the signs on wages that perhaps showing that inflation could last for a little bit longer. But the other wild card, I think, is this dual stimulus from central banks and governments. And if you think about it, it's a bit like riding on a tandem bike. It's much easier to generate speed when both of the cyclists are pedaling away. And it seems as though central banks are sort of erring on the side of tightening policy too late rather than too early, thinking about lessons learned from the last cycle. And governments appear willing to keep up spending as well. And so that combination, I think, could really stoke demand, and price rises could perhaps be more sustained going forward. Now, ultimately, I don't think we expect runaway inflation, and perhaps we're looking at higher inflation this decade than the last. But what we're watching out for is risks that policymakers just overcook that stimulus, and inflation ends up being higher than perhaps you would expect.
And will central banks ever be able to normalize interest rates? Well, will they ever be able to raise them, or is it all just a myth? And as soon as they do, everything will crash and we'll have to start everything all over again.
Yeah, in short, I think they will. And I think really the change in the fiscal stance has really allowed them to think about raising rates. But I do think that central banks are going to be looking to really take baby steps here. Like the Fed are aiming for above 2% inflation, essentially, to make up for low inflation in the past. And they've also spoken about having employment be as broad as possible, something that was really lacking in the last cycle. So again, the Fed appear willing to just err on the side of being too late rather than too early with its rate hikes. So what we may see is, whilst they're expecting at the moment, telling us that there will be 2 rate hikes in 2023 and actually possibly risk of a rate hike coming actually in 2022, I don't think they're going to take place at the same sort of pace that we did in the last cycle. The Bank of England, for example, I think they're probably going to be the first major central bank to actually increase interest rates. We're expecting them to raise the rate to 25 basis points in the middle of next year, roughly. But what they're telling us is once they reach 0.5%, that they're going to start to focus more on reducing the size of its large balance sheet. So again, showing us that whilst they can increase interest rates, they probably won't go too far. And certainly in the Eurozone, when we think about their sort of low inflation and low rates are really much more entrenched there. So the prospect of higher rates is, I think, much further away across Europe.
Now, in the past year, we've seen these big swings between growth and value equities. Is this set to continue, and how should investors position for these big movements?
Sure, yeah, I think the debate between growth and value is such an interesting one, sort of coming out of the COVID crisis. And we know growth was the clear winner in the last cycle, and even during the pandemic, investors were really willing to pay up for growth stocks, given the slow growth environment that we've seen. So I think, when we've spoken about this healthier growth outlook, I think that means the premium that people were willing to pay on growth stocks is maybe not necessarily justifiable. Of course, I do acknowledge that during COVID, we've had this sort of acceleration of technological trends, and that will continue to benefit some of those growth names and tech names. But I think if we do look at the valuations, for example, on growth stocks, they do appear extended relative to value in a historical context. And the beginning of this year, I think, has shown quite clearly that value could have an important part to play in portfolios going forward. US bond yields rose in the first quarter off that stronger growth outlook, and value actually outperformed growth. And with bond yields at low levels and seemingly picking up, and the growth outlook looking fairly positive, that rise in bond yields could really support value going forward. And at the same time, growth names, which tend to have their sort of earnings projected to be realized much further in the future, when you see those bond yields rising, that just puts pressure on how we value those earnings right now. And so what this means for us, I think, is argues for a much more balanced approach between growth and value than we have seen over the last 10 years, with potential favor for value coming, more in our minds now.
What is your view on emerging markets at the moment? And what are your thoughts on the recent Chinese intervention in some of those stocks? Has that changed your view at all?
Sure, yeah. I think, look, we're always aware that there can be short-term volatility within markets, and that's particularly the case with emerging markets. This is nothing new for them, right? China's regulatory interventions, I think, are focused on industries that don't necessarily align with the long-term policy goals of the authorities there. I think that's why we've seen a lot of these interventions really focused in the education sector, given its impact on social welfare and population levels. And what this has done is create a lot of uncertainty for the earnings stream in some of those sectors that might be targeted. But what we don't really think that this is in the interest of Chinese authorities to close up its markets to foreign capital. Indeed, I actually think the long-term objective for them is actually quite the opposite, to actually open up its markets to foreign investors. And we've seen, both the Chinese equities and bond side becoming a greater proportion of global markets. Now, I think it will take some time before the regulatory landscape becomes a bit clearer, but we don't think it detracts really away from the long-term growth opportunity in China and emerging markets. And I think particularly in China, this is really going to be based off the health of the consumer and the potential success of the technology sector going forward.
Great. Well, thank you very much for joining us today, Jay. That was very interesting.
Thank you.
And if you'd like to learn more, please visit fundcalibre.com.